the Property Pod. Welcome to the Property Pod with Moneyweb. The property sector is an ever-changing sector. And in this podcast series, your host, Suren Naidu, chats to movers and shakers in the property industry.
Hi there and welcome to another installment of the Property Pod, South Africa's leading property investor podcast. My name is Suren Naidu, Deputy Editor at Moneyweb, and on this weekly show and vodcast soon, watch this space, we gain insider insights from leading executives, analysts, developers and entrepreneurs in the country's dynamic real estate sector. Redefine Properties is one of South Africa's largest JSE-listed property groups, with assets here and in Poland valued at more than 103 billion rand. The group, which is invested in retail, office and industrial property sectors in South Africa, has been more optimistic over the last few years, touting the coming upside. But the question is the upside here, especially considering the bullish performance of SA REITs on the JSE last year? On this latest podcast, we are joined by Ntobeko Nyawo. I hope I pronounced your surname correctly, but Ntobeko is the CFO at Redefine to weigh in on where the sector is, more comments around the economy, as it were. We have had Andrew Cornett, the group CEO, a couple times on the pod, but this is Ntobeko's first time. Welcome to the Property Pod, Ntobeko. It's good to have you debut on the podcast.
Well, thank you, Suren. Thank you really for having me. It's such a pleasure. And I think you're quite right. At Redefine, we are we call it the upside, but it's really our mindful optimism. And that takes into shape, I think, some of the momentum that you've seen in our macros. Inflation targeting, GDP growth is moving in the right direction. And those are the things that we really are seeing in the macros and the momentum. And definitely, to your opening question, the macros are telling us that the upside is here. Hence, it's positive to listed property.
So you expressed that view ahead of the midterm budget in November. Things have changed a little bit. The JSE actually ended on a record high, even the SA REIT sector. But the February budget is coming up in about a month's time with our finance minister. Are you confident about SA Inc., the economy? We're talking higher growth over a percentage, but SA Inc. overall?
SA Inc. overall has made very exciting strides. I think we don't really give ourselves enough credit as a country. So if you look at the Operation Vulindlela scorecard, the reforms that have taken place in electricity generation, that has given us amplitude lots of strategic opportunities. One, to solve for the basic need in the economy, which is electricity, but more importantly, innovative things. If I look at our numbers last year, for example, solar contributed 156 million of savings in our numbers. That's quite substantial. That's all of the things that now we're getting to do. So in February, it is quite busy, but I think before you even jump into February, January is also exciting. Next week, we're going to hear the MPC, the first MPC of the week. We'll hear what the Reserve Bank has to come out there. Then, of course, February is quite packed. It starts with the State of the Nation address by our president, and that builds up to the budget later on in the month of February. So the ratings upgrade that we saw as a kickstarter to this long journey that our country is taking on the reforms is quite pleasing, but it's going to be a long journey. But we believe that the Minister of Finance and the Treasury will continue on this trajectory, which is fiscal consolidation. Be prudent about managing the economy and then start to really steer the growth, because you're quite right, Suren. It's good to see the positive growth in the economy, but realistically, to solve some of our challenges in South Africa, we need north of 3% GDP growth. So we're nowhere near where we're supposed to be, but it's encouraging to see the positive trend.
Thanks for that. You talked about ratings upgrade. That was in November. S&P gave South Africa the first upgrade in 20 years. Obviously, the last 10 years, it's been on the decline and below investment grade. Do you believe South Africa is still on the path to attaining that investment grade re-rating, even though Moody's was a bit cautious and kept their rating unchanged?
Yeah, look, Suren, we've started a journey on a positive one. I think, firstly, really the medium-term budget speech, the Treasury articulated a very clear path in terms of where our debt to GDP will peak. In the medium term, that is expected to peak at about 77%, which we're all, hoping it never breaks 80, which is good to see that there's a very clear fiscal consolidation path. And I think as we then get the economy to grow, plus the discipline in the fiscal consolidation, I think we got probably the meaningful steps will be taken over the next 3 to 5 years. Then we're going to start seeing some benefits of this in the 5 to 7 year period out of the economy. And then hopefully all other rating agencies will have us at investment grade. We are 2 or 3 notches away from that. So it is possible.
Can I put you on the spot? Do you have an ideal year that you'd like to see South Africa go back to investment grade?
Look, we all wish it should be done faster because we definitely need the GDP. I think realistically, it's somewhere between 5 and 7 years. But if we do consolidate and accelerate, we probably maybe will have it done within the next 3 to 5 years.
And you talked about that. There's a lot of positivity in the market at the moment. But how does this play out for the listed property sector? Will the rally continue as GDP picks up? I know a lot of executives, including yourself, have been quite vocal that a key part of the property industry, growing at greater rates is the economy growing.
Over time, property is linked to the economic growth. That we agree quite rightly so. But I think if we look, last year, the SA REIT, the chart book actually raised a very interesting point for us is that the market cap of SA REIT index went through 300 billion in November last year. That number hasn't been seen since 2019, so it tells you even in those levels, you still have the listed property sector trading at a 20% discount to its net asset value. So there is still upside, I think, in terms of how long is the run going to be. But I think a function of that pace of the run will really come out of 2 things in our view. It will come out of what happens to the economy. I think if the economy maintain above average, which the current average economic growth rate of about 1.3 to 1.6, if we can start beating that, then we're going to have a very good demand-driven taking up space in our assets and across the sector. But equally so, I think there's certain things that are peculiar then to SA Inc. The stability of our GNU, which will dictate the consistency and in the policy direction of our country. Those are all the things that we need to work and then get us into the right direction.
Well, it is the local government election year, so hopefully there's not too much of disturbance from that perspective and we continue on this path. Ntobeko, since you are the CFO at Redefine, it might be a bit of a technical question, but there has been talk about the bond market having boosted the listed property sector. How much of that did play a role in the performance of the property boom, as it were, listed property boom last year? And do you see that continuing together perhaps with the interest rate cuts that we saw last year? And, there is some optimism, maybe not for January, but some commentators are expecting a few more cuts by the SARB later this year.
Yeah, definitely. And we benefit as it's really an issue of asset allocation over time by the guys that allocate to our market. Is that if you look as bond yields compress, that's really when the bonds become expensive and then property benefits out of that. So we've seen, I think you saw in last year, the long bond yield in SA compressed closer to, and it broke even 9% towards the end parts of last year. And that really also benefits the property sector. But from an interest rate cycle point of view, what is really interesting, we're looking at probably if the market consensus is right, there is, if you look at the forward curve at the moment, there is a 25 basis point that is factored into the early parts of 2026. And that continuation, not only does it affect, the cost of debt through the cycle for a REIT, but it also has far much more bigger fundamentals impact from a disposable income levels that our shoppers will have. It will then grow the trading densities in our properties, and then we will have this cycle of growth coming through to continue and sustain the positive growth momentum that we've seen. I mean, if I look around in our sector, most of our sector players have issued positive earnings guidance, which is quite an encouraging sign that the confidence is back that the REITs can deliver growth again in this environment.
Well, Redefine was one that upgraded and delivered a 7.8% divi growth for its last financial year to the end of August. My next question was just a continuation from there. How is Redefine positioned to benefit from these further cuts and the positivity and, greater economic growth expected? Obviously, it doesn't directly affect your sector, but the commodities boom is being trumped up, as it were. South Africa is benefiting from that. But last year was a standout year for the REIT sector. Redefine itself had a total return, believe it or not, of over 50%. That's like unbelievable numbers, and it was a handful of stocks that delivered that. Redefines your expectations. You're not in a closed period, but a little bit more insight from a Redefine perspective.
So look, I think we were quite pleased as well with our results last year. And we also guided to a positive earnings growth for 2026, which actually tells you how confident we're looking into the outlook. But just one of the key drivers, if you really look through our numbers and our business model, is that the core strength of our business is diversification. It is a retail-led portfolio. I mean, I think here in South Africa, 45% of our South African assets is actually in retail across segments. We've got one super regional, then diversified into other formats. And then we've got an exposure to the office sector. We've got an exposure to the industrial sector, which is about 20% of our portfolio. Then the offshore strategy is really focused into Poland, with largely also led by retail plus our logistics platform. Now, if you take that diversification strength comes through in terms of how these portfolios behave through the market cycles. And I think we continue to see a very strong recovery in retail, which is very pleasing for us. We're seeing trading densities are growing, and we expect that to continue given where we are in the interest rate cycle, and that the consumer will be better off from a disposable income point of view. In office, that's really where the challenge is, but our response has been on keeping a portfolio that is of high quality, that can compete as tenants trade up into better spaces, a quality flight as it's been touted in our market. But over time, in office, it will really depend on the GDP growth that is north of 3%. And I think we've got a very good quality office that can defend. And then our logistics platform has always been defensive, but it also has very exciting opportunities. I mean, I think if we get further liberation, which we're expecting in the distribution of electricity, wheeling becomes a reality. We're in a pilot phase now with the city of Cape Town. The unlocking of the roof spaces in industrial space is really a huge opportunity that we pay close attention to from a further solar renewal. So we are excited. I think we think our business is going to continue to trade very strongly, given that it's well diversified. And I think that is a function, Suren, of a very disciplined capital allocation strategy over time that balances geographical diversification as well as sectoral diversification.
Thanks for that, Ntobeko. You mentioned Poland. I was planning to largely focus on South Africa. How is the Poland portfolio EPP doing? Poland is one of the better performing CEE economies. But, the rand has strengthened. Is that a little bit of a concern for Redefine?
So let's start with Poland. So Poland is you're quite right. It is a hub of CEE. I think the GDP in Poland expected to be between 3 and 4% over the next medium term. That's quite strong. It's very robust. We like its fundamentals. Unlike here in South Africa, the Polish economy visually has no unemployment. It's below 5%. So they've got very strong labor, and we like that as a fundamental. Where we actually see the opportunities, I think, in Poland for us is continue with the very dominant retail presence that we've got through EPP. There's a very strong portfolio. And, also then our modern logistics continues to benefit. And I think as we are seeing shifts in the global trades, the positioning of Poland as a gateway into the developed European economies and the West continues to be a strong factor as well. And we're seeing that coming through in terms of the defensiveness of our logistics platform in Poland. So we like that market. We've got to continue investing in it. And I think we are taking the capital allocation in that market quite strategically, as well as it's well positioned for further growth in the CEE space.
And your comment on the exchange rate, is that the stock rand a little bit of a concern, or what's your view on that?
Yeah, look, I think the rand has really ran on a factor of probably a weaker dollar as opposed to anything. And then we've also seen that against the euro, the rand also gained quite a lot of ground. We think it's probably closer now to its fair value range in terms of where the long terms are for the rand. I think between 19 or so to the euro is probably the fair range at this point in time. But what is interesting for us from a REIT point of view is that structurally, still, if you look at 19 rates to the euro, it's still quite attractive from a hard currency point of view exposure in terms of those earnings. But we do prudently hedge, especially that we've got now a very clear, and we control those businesses. So their cash flows and payouts are actually aligned with our group hedging policy. So we've logged in some of the earnings of the next 18 to 24 months. So the rand volatility at the moment, it won't play out too much in the results other than from a translation point of view.
Thanks for that. Ntobeko, since you are a Redefine CFO again, one of the big moves by the group a couple of years ago was a restructure of around 27.7 billion rand of debt into what the group called evergreen funding. How has that worked out for the group? Can you give us an update on that? And it seems to be your baby, as it were. But what other innovations can we look forward to for the group leveraging off that? Because that's a key part of ESG.
Yeah, look, Suren, we're very proud of our common security pool. It has really worked very well in the business. I think if you look at our average debt margins on our rand-denominated debt, it has improved to 1.6% since we actually put the CTA. But also, that's really what we really did there. It's playing our business to its strengths. You know, we are a diversified business. We took 45 billion rands roughly of our SA assets, which are the core assets of our cash generation, and then sold our debt to the market, referencing those. Now, what it has done, it has really positioned the attractiveness of Redefine debt into the markets, because as a REIT, we're a highly geared structure. We have to be very efficient in sourcing our debt. That it has met that, and we expect that it will probably continue for a while as well, because the market is also still catching to some of the renewals that are going to come out of this structure. From an innovation point of view, our group is really focused on profitable growth, and that's why we've got a number of initiatives across the value chain in our business. You know, solar is one of them in terms of retail application. You know, we have now about 18% of our retail SA portfolio being generated from renewables. We want to grow that. We want to do so many things. But the measure over time that we kind of hold ourselves to, and that will tell you how much we take innovation to heart here, we want to have a net operating profit margin of 80% across the group. That's really, at the moment, in our last year's numbers, that printed at 76.2%. So we've got quite a bit to go. And a large chunk of it, we expect that it will come from these innovative ideas. But equally so, some of the early and low-hanging fruits came from us restructuring a business like EPP. So that is how committed and invested our business is to innovation.
Thanks for that. Before you go, Ntobeko, you have been with the group since 2020, and you came in December 2020, I believe. So straight after that lockdown hit, having come from Stanlib. How has the rand been for you as an executive in the SA REIT sector and at Redefine? Maybe a little bit of color from your side as a CFO in the sector. Obviously, you play a part in the SA REIT Association and other structures, but it's a little bit better going now, considering the sector rather is doing much better.
No, absolutely. And I think when I joined, some of my friends were asking me what has gotten to me to go to a sector that is so patterned. But I think it has really been, a focused effort. We've got a very focused growth strategy from a capital allocation point of view. We've got a solid management team in place that is led by Andrew. And if you look at how the market has rewarded some of that consistency, I think since I've joined, the market cap of our business has almost doubled to north of 40 billion rands now. So, and the sector as well, you'll have seen that the market cap for the SA REIT index is getting back to the highs. So I think if you ask me, it's that as a business, we're fairly confident, we're well positioned. But I think also as a sector, it's probably the time now where there's a couple of things that are going to shape this continued momentum, especially now in 26. I think the local elections that are in the later parts of 26, around November, will be pivotal because they will determine what happens in terms of how the local metros are ran. If you address some of those challenges, you're addressing water infrastructure, you're addressing the backlog that we need to be solved for the roads, and then the National Treasury and our sub has got a very strong footing and alignment in terms of lower inflation targeting at 3%. If inflation expectations are anchored at 3%, the benefits in the long term are quite clear for the REIT because the cost of funding will naturally become lower. Then we're going to become more attractive as a sector, which we really do need because our sector does play quite a pivotal role in the nexuses of how capital gets formed to drive economic growth over time in our country. So we're quite positive, and I think, Suren, these are the good times, and hopefully they're here to last if we do our bit as well as a sector.
These are the good times. That's in Ntobeko's concluding remarks. Ntobeko, thanks so much for your time on the podcast. That was Ntobeko Nyawo, the Chief Financial Officer of Redefine Properties, on our latest podcast.
Thanks for listening to the Moneyweb Property Pod with Suren Naidu. To listen to more episodes, go to moneyweb.co.za or the Moneyweb app and follow Moneyweb News for daily updates. Follow Suren on Twitter @Suren Naidu for more of his property industry content and other business stories. The Property Pod.